In this video, we're going to discuss the impairment of debt investments, in other words, bad debt expense for potential credit losses. Let's begin by taking a look at hold-to-maturity debt investments. Again, these would be loans, receivables, or other debt securities that we're measuring at the amortized cost. And from an accounting perspective, what we're going to want to do is make sure that any expected losses due to credit losses, get recognized as part of net income. On the other hand, if we have trading securities, and again, those were the ones we've bought with the intention of perhaps flipping for short-term profits, those are recorded at fair value, and gains and losses, again, are recorded as part of net income because we're doing this as part of our day-to-day operations, buying and selling debt securities. So that's part of operations, record unrealized gains and losses as part of net income. And in terms of any credit loss, the impairment will be measured as the difference between the lower of our amortized cost or our fair market value. And we're going to take a look at examples with respect to these later on. The idea here is we can't take a loss greater than the amount of our unrealized holding loss because we can always sell the securities and minimize that credit loss. Again, that'll become a little bit more clear as we look at an example later on. Then finally, we had our available for sale debt securities, and these were ones that we neither planned to hold until maturity, nor did we buy them with the short-term intention of making a profit. And recall, available for sale securities, any gains or losses are recorded, or unrealized gains or losses are recorded in other comprehensive income, that separate equity account. And from an accounting perspective, when we're talking about credit losses, we won't record credit losses if the fair value is greater than our amortized cost, because we can always sell it and record a actual gain. So we won't incur a loss if the fair value is greater than our amortized cost because we can liquidate it. However, if our fair value is less than our amortized cost, we will either have an expected credit loss or possibly an expected credit loss along with an unrealized loss on our investment. Any credit loss can't be bigger than the loss we would take if we were to turn around and sell the investment or liquidate our holdings. In general, when we're talking about impairments of value related to credit loss, we're going to follow the same rules we did back in Chapter 7 for accounts receivable. We will estimate any bad debt expense and record a related entry to our allowance for doubtful accounts. So that's all that's meant when we talk about an expected credit loss. This is the exact same expected possible loss or write-off we had with respect to receivables. Accounts receivables and other types of receivables. We estimate that credit loss and make a year-end adjustment to bad debt expense. We debit bad debt expense and we credit our allowance for doubtful accounts. Then, of course, when we realize a loss, in other words, write off a receivable, we charge that against the allowance for doubtful accounts. Let's take a look at an example as it relates to our debt investments for hold-to-maturity debt investments. In our example, we're told the Strickler Company holds held-to-maturity debt securities with a par value and amortized cost of $1 million and a fair market value of $800,000. And now we've determined that it's probable that it's not going to collect all the amounts due. And in fact, it reports a loss on impairments of $200,000. And how do we do this? How do we report this impairment loss? Well, again, recall, if we have used our credit loss model, we've already recorded an entry for bad debt expense and an expected credit loss, the allowance for doubtful account. So much like when we write off an accounts receivable and we would credit accounts receivable and debit the allowance for doubtful accounts and tear that receivable up, in this case, when we expect an impairment, a permanent write-down in the value of that debt investment, we will reduce the debt investment with a credit, in this case of $200,000, and we will take that out of the allowance that we've set up or established prior to that as part of our year-end adjusting process. So again, this is similar to the actual write-off of our accounts receivable against the allowance for doubtful accounts. On the other hand, what if we had debt investments that are classified as available for sale? In this case, what we're going to do is use our impairment model, but if the fair value is greater than our amortized cost, in other words, if we could actually sell them more for what we have them on our books for, we're not going to take a loss because we could just as easily turn around and sell the securities and avoid that credit loss. Any impairment loss on available for sale securities will be limited to the difference between the fair value and our amortized cost. Let's go ahead and take a look at 3 examples to illustrate this, and they all relate to available for sale securities. And we're going to take a look at the amortized cost, and we're going to compare that with the security's fair value, and how does that relate, that difference between fair value and amortized cost relate or compare to our expected credit loss. And then based on this relationship, we'll either record a credit loss, which becomes part of net income, or we will record an unrealized holding gain or loss, which will of course be reported as part of other comprehensive income in the equity section. So our first situation, the debt investment are on our books for $1 million, but the fair value is $1,100,000. So we cannot have a loss on this because we just turn around and sell it or liquidate it at $1.1 million, and we've fully covered our costs. So despite the fact that our credit loss, expected credit loss, is $110,000, we'll never suffer that loss because before we take a hit of $110,000, we will simply sell it for $101,000. So we record this at fair value, and we will report $100,000 unrealized holding gain on this debt investment, despite the fact that potentially, if we hold it to maturity, we could incur a credit loss. Scenario 2, it's on our books again for $1 million, but in this case, the fair value is $960,000. So potentially, we've got a loss going on here. In fact, our expected credit loss is $110,000. But again, we won't take a full $110,000 loss. Why would we? When we could turn around right now and sell it for $960,000, and we would only have a $40,000 loss. So we will recognize a credit loss up to $40,000, and that's the difference between our fair value and our amortized cost. So that's it. End of story. So had we recorded an unrealized loss by simply comparing the fair value to the amortized cost, if we had no expected credit loss, so in other words, if this had actually been 0, then we would have reported the unrealized holding loss down below and nothing for an expected credit loss. But in this case, we do have an expected credit loss of $110,000, but we're going to limit it to the actual potential loss, which the most we could incur would be $40,000 because we would simply sell it for the $960,000. Let's look at one last scenario. In our last scenario, we still have the same amortized cost of $1 million. We still have our same expected credit loss of $110,000. But notice, right now at this point in time, if we look at our fair value loss, we have an unrealized holding loss of $140,000, which exceeds our expected credit loss. So of that $140,000, we're going to report the whole thing. $110,000 we will report as an expected credit loss, and the remaining $30,000 we will report as an unrealized holding loss in the equity section of our balance sheet. I just noticed we weren't particularly consistent with our parentheses in this example. Again, this $100,000 right here, a gain. The other numbers here, losses. Let's take a look at an example. All right, we've got 3 independent cases, case 1, case 2, and case 3. In all situations, we have an amortized cost of $100,000. That's what the debt investment is on our books. And again, these are available for sale securities. And we are going to have an estimated credit loss of $4,000. So let's go ahead and take a look at case 1 to begin with. Amortized cost of $100,000, fair value of $102,000. That means that we have potentially a $2,000 gain. So if we've got a $2,000 gain, of course we won't record any credit loss. We will never have a credit loss or accept only $96,000 for these debt investments, not if we can sell them 102. So we will report nothing for the credit loss, and we will report an unrealized holding gain of $2,000. So we debit our fair value adjustment for $2,000, and we credit the unrealized holding gain. And again, that's part of the equity section, other comprehensive income on our balance sheet. Let's go ahead and take a look at scenario 2. Amortized cost $100,000, but now we have a fair value of $99,000. So we potentially can have what? A $1,000 unrealized holding loss. But since we're told that we have credit losses of $4,000, that's what we're going to record. Again, not the full $4,000, because we would never accept, again, the difference between these two is $96,000. We would never accept $96,000 in settlement, not when we can sell it for $99,000. So we will limit our credit loss to $1,000. And again, that credit loss will get reported as part of net income we'll see. And of course, if we recorded the $1,000 credit loss, we have no unrealized holding gain or loss. And our journal entry is debit to bad debt expense. There's our loss. And we credit the allowance for doubtful accounts for that expected credit loss down the road. Scenario 3. What do we got going on? Amortized cost of $100,000, fair value of $99,000. Potentially we have what? A $10,000 unrealized holding loss. But some of this we're going to attribute to our credit loss. So we're going to record $4,000 of that $10,000 as a credit loss, and the remaining $6,000 we will record as an unrealized holding loss. So in terms of our journal entry, the credit loss, we debit bad debt expense for $4,000, and we credit the allowance for doubtful accounts. We set up that allowance. For the unrealized holding loss, we record an unrealized holding loss debit of $6,000, which again becomes part of other comprehensive income in the equity section, and we credit the fair value adjustment for $6,000. Again, these are the entries we make when we set up our allowance for doubtful accounts. When we actually write off or record an impairment, an actual impairment rather than an expected impairment, then we would take it out of the allowance and reduce the debt investment accordingly, just like when we write off an accounts receivable.